This is Mike Wilkerson. I am the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. I'm coming to you today, Saturday, June 3rd, with the June monthly update for Stormwall Advisors, where we hit on issues in the markets, the economy, geopolitical, geostrategic situations, etc. This month, I want to focus on the debt ceiling debate and what is now a bill signed into law today. And talk about the implications for the next phase of the banking crisis. So let's go ahead and jump right into it. I'm going to share my screen and pop up into the corner myself. Let me see if I'm doing this right. I think that's it. There it is. Okay, so here we go. June is mentioned, and we're going to start going through this. I want to talk about the debt ceiling and why it matters. And today, just news that Biden has signed the debt ceiling bill. He said that it's a critical agreement, that this avoids default. But what it does also do, or what it fails to do, is to confront the underlying problem. It suspends the debt limit until 2025, until after the next presidential election, restricts government spending to a degree, but it fails to address the underlying issue of deficit spending and the mountain of debt. So the debt service in the U.S. is now the largest single line item of the federal budget, bigger than the defense, which of course is astronomically large, close to 800 billion, or if not more by now. So I'm going to talk about this a little bit and argue that this sets the stage for the next phase of the banking crisis. Here is the underlying issue. So the United States federal deficit is absolutely unsustainable. We as a nation, as a country, have accumulated nearly $21 trillion in cumulative deficit since 2001. 6 trillion of this was accumulated during two of the pandemic years. And while the Biden administration has taken credit unto itself for reducing this down from those levels to $1.5 trillion in the last 2 years, it's still way too much. And of course, way higher than anything before that, except with the possible exception of the global financial crisis years, which you see in the middle. This is unsustainable. And I want to make one point here, which is that if you look at the history of hyperinflations and high inflations, and they're all 20th century, and they're all based on fiat currencies, it is excessive government deficits that spark hyperinflations, spark high inflations, when governments start spending more than it can control. If you look back at what happened in the global financial crisis, it was not government, but it was unsustainable household debt that helped fuel it. We know, of course, about the housing market, everything that was going on, inflated prices. Consumers, households were in way over their heads. So at that point, household debt as a percent of GDP was nearly 77%, and at the very peak, even higher than that, at over 100%. So if you look at where we stand today, household debt GDP is down 23%. Households, consumers, individuals have delevered. That's a good thing. And of course, they started borrowing again as low rates encouraged borrowing and taking on more debt. Service costs have started to rise again since 2020, and that's putting a limit on how much consumer debt people can take on, although it has been rising. Corporate debt also not super significant, up a bit. It was about 45% in the GFC, now 48%. But here's the issue. So government debt is now over 120% of GDP, of gross domestic product. Product that is now, all of that is federal. At the time of the global financial crisis, it was 77%, which means that the government had room to maneuver at that time that it doesn't really have now. 120% places the U.S. in one of the top 5 indebted large countries of anywhere in the world. States and municipalities, this is a tale of two cities, in that we're now lower states on average than we were at the time of the global financial crisis, but there is a wide divergence between states that have been more conservative, more responsible, and those that have continued to spend on failed programs, especially through the lockdowns and pandemic period. So here's the takeaway of this. The U.S. is now more indebted than it was during the global financial crisis. If you add up all of these categories of debt, again, it's a percent of GDP, because absolute dollars don't mean quite as much. You see that at the time, Total debt down here at the bottom of the slide, total debt to GDP was about 242%. Today, we're at 257%. In other words, we are more indebted than we were on the eve of the global financial crisis, on the cusp of it, going into in 2009. So we're not better off, we're actually worse off. And again, a lot of this is attributable to the rise in government debt, federal government debt, which in turn is a consequence of deficit spending. Now, I argue that the crisis in the banking sector is not over, that we've got more to go through. If you missed the last month, I talked about 3 of the 4 largest bank failures ever have occurred this year. In fact, over the course of about 2 months. So back here in the global financial crisis, Washington Mutual, which at the time was the 6th largest bank with over 300 billion of assets, has now nearly been eclipsed by what has happened this year so far with First Republic, Silicon Valley, and Signature Bank, basically more than twice as large in total. And it's all come out of nowhere. Now, the good news, or relatively good news, and that people are talking a lot about, is in the last few weeks, things have quieted down. But I want to remind all of us that there were 6 months that lapsed between the forced sale of Bear Stearns to JP Morgan in a rescue of that nearly failing investment bank. And it was 6 months later, in September of 2008, when Lehman Brothers was forced to declare bankruptcy. Over the course of the summer, there was many pundits and experts were saying the worst is over, it's behind us now, it's going to get better. And I think it's just important to remember that these things do come in waves and ebbs and flows along the way. If you caught this video last month, we talked about the fact that we've seen, the banking system has seen $1 trillion worth of deposits that have left these banks, mostly the regional and smaller banks. It's not been the case for JP Morgan, for the other 2 big to fail banks who have held on. And we have seen, after that big run that was right in the epicenter of the crisis in March and April, some at least temporary stability, and the deposits have maintained a level of about $17.1 trillion over the last few weeks. So that's encouraging. There's some stability here. However, we face a new issue for the banks, which is, if you look at what was going on with the U.S. government and why this issue of resolving the debt ceiling was so critical and existential, although I wrote several weeks ago that there was zero chance there was going to be a substantive default, that this was, of course, brinksmanship and positioning and fear-mongering. The point here, and what you're looking at, is this is the U.S. Treasury's general account. Okay, this is the centralized fund, the bank account, or the account from which the United States government, through the Treasury, pays all of its bills, whether to creditors, bondholders paying interest, or actual employees, federal employees, and otherwise. And if you look at a year ago, the balance that the Treasury maintained in sort of an ordinary course way to keep things liquid and safe was about $800 billion. As of just a few days ago, on May 31st, the last date that we have for which we have data, the balance in the TGA had fallen to $49 billion. That is the lowest level since 2017, around the time that we last had a brinksmanship debt ceiling cap debate and crisis like this. And the Treasury, of course, was very loud in saying that they were about to run out of cash within days. So why does this matter? Well, the U.S. Treasury, now that this deal is signed, is going to begin a program, a process of replenishing the coffers, of filling up the wells of its own liquidity. And in order to do that, it's going to have to issue U.S. Treasury bills and bonds in all sorts of ways, through auctions and otherwise. Some analysts are estimating between 700 and 800 billion. In other words, to get it back up to that stabilized normal level that we talked about. At current yields on U.S. Treasuries, which, by the way, are more expensive for shorter dated at 5+%, or just 3.7 for 10 years, this is going to cost the U.S. government an additional 25 to 40 billion on an annual basis at those yields. Now, for investors, this is great news, because depositors who are stuck in banks at 25 basis points or 1% for their savings or CDs see the opportunity in treasuries, see the opportunity in mutual funds, money market funds. And that's why we have seen, that's a big part of why we've seen the deposit run that's occurred over March and April. Now, the point here is that as Treasury raises money, people invest, depositors and investors invest in these treasuries, and that is going to continue to drain more liquidity from the banking system. And we can expect, as a result, that banks are going to again be under pressure for their deposits. And I have to say, the banks are facing a bunch of very terrible and tough choices. Their executives expect to see increasing losses as the economy struggles, as especially in the real estate and other sectors, folks are having a hard time repaying their debt or keeping up with their obligations. They're doing all they can to shrink their credit risk. They're making fewer loans. That's bad for the economy, kind of creates the recessionary pressures of inability to grow businesses. And at the same time, the executives are trying to shrink their balance sheets by selling off whatever marketable securities they can and loans that they can, if they can find buyers for them. The problem with this is if they sell these securities and these loans at losses, which is what was happening to Silicon Valley, to First Republic, and otherwise, it generates losses, which depletes the bank's capital. It's very difficult for them to raise new capital in this environment where their share prices are extremely depressed, and in many cases, trading below book value. In other words, at a level where it's just actually dilutive for them to raise more money. So it doesn't make any sense. They're really stuck. And of course, living in this deathly fear that deposit flight may resume. So in summary, I think we'll close out the section just to say there is a risk that the banking crisis continues, that we see further pressure on bank deposits, on bank liquidity. And of course, that impacts all of us, whether as individuals, as households, as business owners, or market participants, as go the banks, so often goes the economy. I want to turn now to talk a little bit from more of a consumer or business-facing standpoint, which is based on something I wrote a few weeks ago. And I want to make the point that inflation is actually worse than it appears. So first of all, how does it appear? Well, there was some good news in the last CPI report that was down slightly to 4.9 from March's 5%, and of course from the June peak last year of over 9%. However, I need to keep reminding all of us that 4.95% is way ahead of the Fed's target and what one could consider healthy pricing action, healthy price stability. We're still in an inflationary environment, and of course, with the compounding effects, base effects of year upon year of inflation above these levels, real prices have gone up quite a bit. But I want to make the point that CPI is underestimating the real inflationary pressures that we're seeing across all kinds of other categories. Before we do that, just want to mention one area where it's definitely not keeping up is in terms of real income. So after the CPI, a few days later, the Fed's favorite metric, as they call it, which is the PCE, personal consumption, real personal consumption expenditures, was up 4.4%. That was actually an increase from March's level, 4.2%. And core PCE, when you exclude food and energy, was up 7.7%, also higher than March. So again, not looking good. The Fed is facing these real pressures that inflation is higher than what they would like. And the challenge here is that workers are falling behind, because real PCE, when you take into effect inflation, was up 0.5% month over month. This isn't yearly, but then now we're looking at monthly data. But real disposable income is not keeping up. It was up less than just 0.1% month over month. So workers are falling behind. This is a tough one. Back to the main point. Inflation is hitting all sorts of categories in ways that the CPI data doesn't really reflect. So if you look at the CPI data, it reports higher education inflation at around 2.4% per annum since 2013. But according to the NCES, the Digest of Education Statistics, the cost of higher education has been up 125% since the year 2000. A bit more for public institutions, actually, for state-run institutions, and a bit less for private institutions. But nonetheless, this is over 4% of annualized inflation, nearly double what the CPI is showing. And another report from the Brookings Institute shows that they see in the last couple of years inflation 5% and then 8% in this past year. And the average cost you see in this graph for private institutions, $46,000 a year, public 21, average of 29. I feel this pain as I've just had a son graduate from a private institution in this country, and yeah, it was a lot. Anyhow, but it's not just in education. It looks like in medical care, same thing, that the CPI data is underestimating what's actually going on. analysis from private sources, in this case, PwC's Health Research Institute, shows that since 2006, medical care costs have decreased by 220%, which is an average rate of 7.6%, versus what the CPI shows is 2.6 for the 10 years since 2013, and actually diminishing to 1.6 over the past year, which does not seem to foot with what any of us who have had to deal with the healthcare system actually experience. And also we see it in housing. So CPI shelter since sort of the base year of 2020 up 15.5% or 5% per annum. On the other hand, the Case Shiller Home Price Index shows over that same period 35% increase or 11% per annum. So we're seeing something going on CPI data, which we've talked about, I've talked about, lots of people have talked about for a long time. It's not really representing what's happening in inflation, but we see it across categories: education, medical, housing. I mean, just everything that we have to live on. And some recent data shows the housing price rises, although there's a lot of talk in the market about the market slowing, and indeed the pace of increase is slowing, but nonetheless, we're still up 3.3% year over year. This is down from an incredible 18% increase last year in June 2022, when inflation was really gripping, and that was, of course, the 9.1% overall CPI. Housing was doubling it at the time, and we see rents also up 5%, also down from 17% in early 2022 as people were reopening. So housing again being hit much harder than even shelter. CPI shelter is actually showing. And we started talking about this with the PCE numbers, but we're not seeing nominal incomes rising in a way that can keep up with inflation. So recently we've seen wage growth above 6%, but real average weekly earnings in terms of what people are taking home after inflation for the adjustment in the hours they're spending actually down 1.6% through March, with labor productivity down. So this is tough. This is tough both for companies. This is tough for the middle class, the working class people who have jobs and who are trying to keep up with these rising prices. By the way, I've talked about some of these categories, energy and food, how the same story applies there, that what you're seeing in CPI is not keeping up with them. You can find these at stormwall.com, as you can find pretty much everything else. Let me get out of the share screen. But what I will say is, if you want a copy of this presentation, this information, reach us at hello@stormwalladvisors.com, and you can go to the website stormwalladvisors.com to learn more. I hope this has been helpful for you. There's a lot going on with these numbers and behind the numbers that I think we have to pay attention to, keep focused on. If you've enjoyed this, it's been helpful, please like it, share it here on my YouTube channel, and subscribe, and turn on the notifications bell so you get all this information in real time. Look forward to seeing you again here on the Stormwall Advisors Monthly Update, and on my website, stormwall.com. Have a great weekend.